name is Wei. This is my group member, Eldred, Kerfu, and Jason. Today, we are going to discuss about alternative investments under macroeconomic trends. In the current macroeconomic environment, monetary policy remains constrained in developed markets, especially due to inflation, which limits the scope for aggressive rate cuts. In contrast, China economies, which supported by the people banks of China, are maintaining a more accommodative stance to stimulate growth. At the same time, geopolitical risks like the ongoing Russia-Ukraine war and the tariff between US and China are disrupting global supply chain. Due to the importance of the Straits of Hormuz, it also impacts the global oil supply a lot. As a result, commodity markets are increasingly driven by supply shocks rather than demand cycles. Besides, financial markets have responded with a clear shift toward risk-off sentiment, while liquidity conditions have been tightened, particularly in unlisted markets. Overall, the key implication is that uncertainty is now structural but requires a reassessment of traditional portfolio strategies. Given this environment, we recommend three key portfolio strategies. For commodities, they provide direct exposure to supply-side disruptions and serve as an effective hedge against inflation. Particularly, backwardation offers the potential for additional returns through positive raw yield. Second, with the real estate, we recommend a preference for listed rates over direct property in the short term, because rates benefit from faster revaluation through cap rate compression and also reflect forward-looking market expectation. Third, infrastructure should remain a core allocation within the portfolio. This is because these assets benefit from regulated and WACC-linked cash flows, which make them resilient in economic downturns. However, these strategies involve important trade-offs. Commodities introduce higher price volatility, rates remain sensitive to market sentiment, and infrastructure investment carry regulatory and political risks.
Hi everyone, my name is Tan Fu. Today I would like to present hard commodity crude oil supply shock. For hard commodity, crude oil is a clear example for a supply drive short in 2026. The ongoing Russian-Ukraine war continued to destroy global oil market through sensation and recession on Russia oil exports. Since Russia remains one of the world's largest oil production, this distribution reduces global oil supplies and creates a negative supply shock when supply decrease and price increase. Besides the actual reduction in supplies, investment and market participants also become concerned about future supply stability in 2026. This uncertainty creates a geopolitical risk premium, which push oil price even higher, especially during period when the conflict interferes. This situation would also reflect in the future market in 2026, when oil contracts move into backwardation, meaning spot price will higher than futures price. This indicates strong short-term demand and tidy supply conditions. For investors, backwardation creates positive raw yields. When future contracts are rolled forward, investors can sell high-price near-term contracts and buy lower-price longer-term contracts, improving returns. However, the market also become more volatile in 2026 because prices were high sensitive to geopolitical developments and supply expectations. Moving to the next slide, soft commodity like red in 2026 were more affected by trade policy changes rather than direct supply disruptions. Tariff imposed on red export from major productions such as Russia or Ukraine may not reduce total global supply, but they affect how supply is distributed across regions. For example, tariff increase export costs, reducing international trade and creating regional imbalance. In 2026, exporting countries could experience excess domestic supplies and falling price, while importing countries face shortage and rising price. Unlike supply shock, tariffs create market inefficiencies and distortions in future market. This may lead to contango when future prices are higher than spot price because of higher storage costs, transportation costs, and uncertainty. For investment in 2026, return become less predictable compared to oil market. Oil yield could become negative, and price may not fully reflect actual global supplies and demand conditions. As a result, tariff-driven disruptions create more uncertainty and volatility, making a resilient market hard to negative. Coming to the diagram slide, this diagram summarizes the different transmission mechanisms between supply shock and tariff impact in 2026. On the left side, the Russia-Ukraine was create a supply shock in current oil market, global supply decreased, price rise, and the future market moved into backwardation, creating positive raw yield and stronger investment returns. On the right side, tariff affecting wherein create trade balance and disrupt trade flows. This causes regional imbalance between exporting and importing countries, leading to contango and increasing market uncertainty. Overall, in 2026, supply-driven stocks such as oil create cleaner and more predictable return opportunity, while drive disruption in unregulated market introducing more complexity, inefficiency, and volatility for investors.
Alright, for this slide, I will explain how falling interest rate affect listed REITs compared with direct properties. When interest rate falls, the required return of investor also decreases. This increases the present value of future rental income, which can push property values higher. Falling rates can also lead to cap rate compression, meaning valuation increase. For listed REITs, the impact is usually faster and stronger because REITs are traded on stock markets. Their prices adjust almost immediately based on investor expectation. Investors are forward-looking, so they may price in the future rate cuts before they fully happen. RITs are also highly liquid, which allow faster price discovery. In addition, if RITs have floating rate debt, lower borrowing costs can improve returns. In contrast, direct property respond more slowly. This is because direct property is usually valued through appraisal, rely on historic transaction data. As a result, there is a lag effect and valuation may take months or quarters to reflect changes in the interest rates. Direct properties is also less liquid and often supported by fixed rate financing, so the impact of falling rates is slower and more stable. So overall, listed REITs revalue faster while direct properties adjust more gradually. Next slide. For this slide, I will explain why infrastructure can act like a regulatory moat. Infrastructure assets such as energy, water, and transport often operate as regulated monopolies. This means there are high barriers to entry because their assets require large capital investment, government approval, and long-term contracts. The return framework is usually linked to WACC, or weighted average cost of capital, because infrastructure provides essential service cash flow are often stable and predictable. When interest rate falls, borrowing costs decrease and the present value of long-term cash flow increases. This can support higher valuation and stronger returns. Infrastructure also have a defensive nature. Demand for essential services such as electricity, water, and transport usually remain stable even during economic downturns. This makes infrastructure attractive in risk-off environment where investors prefer safer and more predictable assets. However, there is still risk since infrastructure is regulated. Government or regulators can intervene in pricing and allow the returns. Also, not all infrastructure assets behave the same way. Utilities are more stable, while transport assets can be more cyclical because they depend more on economic activity and user demands. In conclusion, infrastructure is attractive in falling rates environment because of stable cash flow, lower financing costs, and defensive characteristics. But investment might consider regulatory sector specific risks.
Hi everybody, my name is Jason and I will be talking about why AirAsia is a commodity consuming firm. So AirAsia, like all airlines, is highly exposed to jet fuel price volatility. To manage this risk, the company hedges Brent crude oil futures by taking long positions in 3 to 6 months contract and using rolling techniques. Thus, AirAsia can continuously renew its hedging position. As you can see in the first chart, Brent crude oil prices have fluctuated significantly between 2020 to 2023. Thus, AirAsia's hedging strategy helps smooth out these swings. And on the second chart shows that how hedging offset rising fuel costs. While actual fuel expenses increased in the late 2023, the hedge costs remain more stable, protecting the airline's bottom line. In short, fuel hedging is a critical tool that allows AirAsia to control costs and reduce exposure to unpredictable market movements. In conclusion, today's macroeconomic environment remains highly uncertain, shaped by geopolitical tensions and persistent supply side effects. These factors have weakened the effectiveness of traditional diversification strategies. So to adapt, portfolios should emphasize real asset with tactical overweight in commodities for inflation protection. Short-term exposures to listed REITs for quicker revaluation and strategic investment in infrastructure for stable defensive income. While these approaches strengthens resilience, they must be balanced against volatility and regulatory risks. Overall, the goal is to build a portfolio that safeguards against inflation and maintain liquidity and deliver steady returns amid global uncertainty. So these are our references, and that's all from our group. Thank you.